Hey, welcome everyone. Today is Tuesday, January 24th, 2023. We are back calling all investors live with Caeli Ridge, and we want to make sure that you understand what's going on. We are still on the Zoom platform, so as always, if you're here live, please make use of the tools in front of you. There's a Q&A, so that's still there. There's a chat also, in case that's your thing. You've got some reactions you can use. And as new people roll in, we'll go ahead and admit those folks in. If you're listening to this on a replay, please get your butt to a computer or some type of technology that's connected to the internet and join us every Tuesday at 4:30 p.m. Eastern for Live with Caeli. Topics always change, so it's always good to stay involved. And today, we put a poll out yesterday in the community, and we asked for some feedback on 3 choices, and the overwhelming request was to look at how the 2022 tax return that you're probably going to start thinking about filing, how that could affect your lending options for at least the next 12 months. Caeli's going to explain to us. Caeli, how do we do that? How do we take care of that?
Thank you, Larry Bailey. Hi, guys. Good to see you again today. So first things first, I want to start by saying the poll that we took yesterday, I love that idea. I'm hoping that you guys approve of that, because I'm thinking between Larry and I, we're going to come up with several different line items of content for our weekly stuff. And we'll maybe try, Larry, we'll try and do it maybe a few days in advance in case it takes extra preparation. But I really want to hear from you guys about what it is based on what we think you want to hear, really what everybody is hoping to get. Now, right, if we don't get to one day, let's say that it's close. We've got 3 topics, overwhelming this one, and then this one had quite a few. We'll make sure to have those on the follow-up weeks so that we cover as much ground as possible. Okay, tax returns. Maybe by a show of your hands in the chat, how many people really understand how to read a tax return? Specifically to this conversation, I want to really focus on a Schedule E. How many people really understand and have spent any time looking at that from a tax perspective, let alone an underwriting perspective? Anybody really have any conceptual knowledge or understanding?
Nobody's admitting to having that knowledge except for Michelle. Michelle says yes.
Michelle's got some. Okay, Michelle's got some knowledge. All right. More often than not, we find that it's like Greek or truly another language when we start talking about tax returns in general. Specifically to this is our Schedule E. For real estate investors, the Schedule E is profoundly impactful in qualifying for the loans in which we're presenting full income documentation. Reminder, okay, we have all the loans available to us that don't require tax returns. So if for whatever reason, maybe strategically, we want to maximize deductions on the tax return, which in turn may disqualify us from supplying documentation to qualify when we're calculating a debt to income ratio, we have all those alternative products. So if we decide in any given year that this year I really want to max out what my deductions are going to be and pay so much less in taxes, as a result, I'm going to look at these other loan products. If Carrie is on this call, well, that'll be part of the discussion when we talk about debt service coverage ratio real quickly. We'll touch on that as the alternative to looking at full income docs. You know, I even have clients, just as a sidebar, that decide that they could actually qualify using their vials of blood, all of their tax returns. But their tax returns are so complicated. Maybe they've got lots of businesses or lots and lots and lots of properties, whatever it may be. It's just not worth it for them. They don't want to go through the hassle of providing all of that documentation to get, you know, a point and a half, even 2 points lower in rate. They're going to take the higher interest rate and have a more streamlined process where they're not having to complete the gauntlet, affectionately, the gauntlet of prequal, right? So there's a variety of different variables that could be part of the individual's decision to really focus on that Schedule E or that tax return for qualifying and or not. The Schedule E obviously is what we're going to focus on today, but a lot of times for a self-employed person that has, you know, a Schedule C, maybe there's a Schedule D, They maybe file corporate returns where there's K1 and distribution income. It gets quite a bit more complicated. So if you're on that side of the spectrum where you're ultra complicated, I would say that that's going to be more individual one-on-one. Okay, so ping us, put it in the chat here, and Larry will make sure that we get FaceTime together and reviewing that. Before I get into this, I also want to remind everybody that has probably heard me say this more times than they want to remember. If qualifying using full doc income, like a debt to income ratio loan, is important to you in any calendar year, do not file your federal tax return. We don't care about state. Do what you want with the state. We don't even look at the state tax returns for qualifying. But do not file a federal income tax return until we have seen the draft version first. The cool thing about this, you guys, is that the calculation, underwriting calculation that goes into looking at a tax return and all the different variables and schedules associated with it is extremely well defined. And even moreover, we know from the purest form what we can use to work towards our advantage. There are things in our industry called overlays, okay? This does not apply to Ridge. We are going to go by the purest form of the definition of guideline, whereas a credit union or a big boy bank or somebody may impose an overlay that might disallow something like an add back of depreciation. It might disallow an add back of one-time extraordinary expenses. Okay, so like anything, lenders are not going to be created equal. For investors specifically, I think maybe for anything, but for what we're talking about today, I think Ridge is uniquely qualified to ensure that we're giving you the best foot forward and the advice and instruction so that we can take advantage of all the nuance of those intricate details and underwriting guidelines. And by the way, yes.
I'm sorry for interrupting you, Caeli. I thought you were pausing. So just for those that have joined up, because a lot of folks have jumped in after we got started, today's topic is all about preparing and reviewing your 2022 tax return and how that might affect your lending options throughout this year and even into the beginning of next year. Thank you, Caeli.
Yeah. So just anybody that just joined, just to reiterate, guys, this conversation is going to be for those individuals that really want to utilize the more favorable rates and terms, right? The more skin in the game that you come to the table with in documentation, right? The more income documentation that you're supplying to a lender for loan purposes, mortgage loan purposes, the more favorable the rates are going to be. As you start trailing down, the less information you're supplying, the higher the rates and maybe less favorable the terms are going to be. Remember, please do the math. If it meant that you're going to have to come up with another $50,000 in taxes to the IRS versus, you know, a 1.5 or 2% higher interest rate for, say, a debt service coverage ratio where you don't have to care about your tax return, do the math on the property. $50,000, $100 a month loss in initial cash flow, right? That's for you to decide, but just make sure you're looking at it from that lens and doing the math from that perspective so that you're making the right decision for that investment. And every investment is going to be slightly different, right? Okay, so where was I? Okay, let me just reiterate, do not file. If you want to qualify for a full doc loan, that means the vials of blood and the DNA samples. Okay, if you want to qualify in any calendar year for a full income documentation loan, then I do not want you filing federal tax returns until you have sent us a draft version first. What we will be able to do with that information is that we're going to take it and run it through those very well-defined pre-underwriting calculations, formulas that we know that Fannie or Freddie or whatever the investor that we're going to be selling to is going to require. We're going to run it through that model, and we're going to be able to see where we get to add back, what things that we can use to advance or help us here or there. But with that, what we're going to be able to present you with is a variety of variables or options or feedback that says, hey, Nancy, there's some losses on here that I think that I'm going to advise you to carry forward into the next year, right? That'll be for you to determine, but you'll have the opportunity in advance to make that determination. Or maybe I'm going to say, you know what, Lisa, you bought a property in November or December of 2022, but you're trying to get it on that tax return, on 2022's tax return. When I see that draft, I'm probably going to say, depending on where your DTI started, I want you to pull that into 2023. There's no income for this property, but you have all of these expenses. that's going to go against you and hurt your qualifications for the remainder of the year once you ring that bell. Remember, once you file that tax return, it's done. Okay. Can we take an amended return? Yeah, but that just gets messy. I would say I would strongly advise anyone against that. Point being is that if you give us the advanced draft return, that gives us those opportunities to have those discussions so that we're setting you up for success in anything that you're trying to do in that calendar year. Okay. Anybody comments, questions so far before I get into this?
So
Yes, Miss
Nancy's
Nancy.
got her hand raised. Thank you very much for being on camera so we can see your hand, Nancy. For everyone else, if you're not on camera or if you're on audio only, there's two ways to interact with today's event. Number one, you can use three ways actually. You can use the chat feature within the Zoom here. You can use Q&A if you have a question we want to cover. And the last is you can just go ahead and raise your hand, whether visually or using the tools here online. So Nancy, let's see if we can get you talking here. So you've been gone ahead. Nancy, what's your question?
She looks like she's on mute, Blair, or maybe that's her.
She's trying.
Okay.
Let's see if we can get that working again here.
There she is.
There we go.
There we
Hi,
go.
Nance.
That was a separate, hey. God, that
Tax
was
returns, schedulees.
I'm
We're going to blame Larry.
Okay, can you hear me?
Yes.
You're good.
Hey, okay, look, so you're saying to file a return if, like, I just bought a property and had a lot of expenditures that it's looking like, I'm just doing the math now, but it's looking like it equals out, you know, the what I had to invest and what so I come out in income neutral on it. And you're saying perhaps take those deductions that you would have taken for this and claim them on next year's, even
potentially. It really so
do that.
Yeah, absolutely. That's well within your now consult your CPA, consult your legal experts, whatever. Larry's going to be the first to jump on me and say that I've got to cover our bases. But within my definition and everything I've always done, it's perfectly within your right, especially if it was purchased late in the year and you don't have any income to show, to pull it into the next year. There will not be any other issues in doing that. The IRS is going to get their money when, in fact, it probably works to the IRS's benefit to show income versus the bigger loss, right? But the other thing, Nancy, I want to clarify for you guys, when you're looking at your numbers, right? However, you're gonna focus on the gain or the loss or the break even or whatever. That's very, very different. That's your reality. That's very different than what the underwriting guidelines are. Right. So what you think might be a small loss might be a huge loss, or what you might think would be a large loss might be a small loss, depending on the different add backs and the different expenses that you're claiming, how you're claiming them. It's a little convoluted, but you know, once you've seen it enough times, you can kind of take a peek at a Schedule E and I can pinpoint fairly quickly what might be an add back and how it might shake out in the end, if it'll be a small loss or a large loss or a big gain or whatever. Am I answering the question though?
I do get it. So mainly what you want to look at before I turn it in is only the Schedule E. Is that correct?
Are you self-employed otherwise? Do you have other income that's not like straight W-2?
Well, yeah, I'm self-employed, but I'm not very active. I'm a licensed realtor, but
okay.
I do practice.
I would say that the only time I just need the Schedule E is if you're a straight W-2 wage earner. Oh. And in that case, I just need the Schedule E. If you have other schedules outside of just a W-2, then I would say give me the whole thing, the whole return. Federal only. We don't need the state. But probably just to keep it simple, guys, just send me the whole return. Don't just send me the Schedule E. Let me see the whole thing.
Okay. Yeah. Last, like really, I don't mean to hog, but last thing is I'm seeing a lot of rate buy downs. This is a new clinic I'm seeing. And also the short-term ARMs have come back. Are those included in the choices that you consider, the options you consider in going after a loan?
Yeah, absolutely. All of the above. Now, whether or not that applies to tax returns and filing or not filing may or may not be the case, right? Maybe we're looking at one of those products in ARM, for example, that's a debt service coverage ratio where we don't care about your tax returns. But yes, absolutely.
Okay, thank you.
Yeah.
Nancy, thank you very much. Sorry for the trouble getting on. And as Caeli mentioned earlier, we just want to make sure that, of course, you're checking with all of your legal and tax professionals for your actual advice that you can take. Ridge Lending Group nor Caeli Ridge are attorneys or tax professionals. So any information you're given are purely Caeli's opinions and should be checked with your professional representative.
Thank you,
There you
Larry.
go, Caeli. There's your
Thank you, Larry.
CYA for you.
Thank you, Larry.
Keeping you honest.
Thank you.
For anybody else, because we've had a few more people join. Again, we're going over preparing tax returns for 2022. And if you have any questions, feel free to use all of the information and all the tools around you in Zoom. We do have a question from Kia. If I'm mispronouncing Kia, let me know. I'm really, really sorry. So the question is, what if you file with your spouse and what if you file with your spouse and she is not interested in investing, so they want to just file? How can a married person maneuver this? Are married couples that file separately a thing? I just jumped on the call, so I may be asking the wrong question. You're muted, Caeli. Hang on, let me unmute you. You muted yourself, and we have to get you logged in here for go ahead. I should have just, there you go.
Yeah, sorry guys. I had to clear my throat, so I muted for a second, not knowing that I couldn't unmute. Larry keeps a tight rope, a short leash on me. So Kia, very good question. The answer is that even if you're filing jointly, but you're going to do this on your own, we will have enough data to differentiate one income source from the other. So if let's say that you're self-employed and you've got a Schedule C, right? You file a Schedule C. We'll know that your business in your name is going to be the income that we're going to find on that Schedule C. Anything else on there would not be included in the qualifying of that transaction. I think that's what you're asking, right?
Yes, her response was,
okay.
Okay, awesome, thank you.
Good. Okay, so one more time for posterity's sake, do not file federal tax returns if you want to qualify in that given year until you've sent us the draft version, at which point together we will go through an exercise that will actually teach you how this is all calculated, right? How you quantify from underwriting the income or the loss associated with that individual property or those properties. One more thing to mention here. I don't want to get too far into the weeds, but this is very, very important. If you are filing, if you have a business return, all your properties are held in an LLC, okay, and you decided to file that LLC as a business return where those properties are going to be on the business return Schedule E, but you have personally guaranteed the debt, the loans on those properties, Fannie Freddie's rule is if within the calculation that we have to do, if there's a gain, if there's a positive number, you do not get to have it. If there is a loss, I have to hit you for the loss up to a maximum of that property's PITI, principal, interest, tax, and insurance. Okay, let me say that again. If you have rental properties that have mortgages on them and that you are personally obligated to that debt, whether it's in your personal name or you signed a personal guarantee, either one of those counts, rental properties with mortgages that you have personally obligated the debt that you have filed on a business tax return. You may not take a gain from the Schedule E calculation. You don't get to have it. You can't keep it. I have to discount it. If the calculation comes out as a positive number, you don't get it. If there is a negative number, you will be hit for the negative number, the loss, up to a maximum of the total mortgage payment of that property. So depending on the desire and the need and some other variables, I see people filing this way because they don't know. And there's no extra incentive tax-wise to do it on the return, okay? Doing it on your personal return, your Schedule E on the personal return for asset protection, you keep them in the LLC, that's fine. They're recorded with the county that way, et cetera. You've got your anonymity. But for tax purposes, having them on your primary personal return should give you all the same deductions. There would not be a difference in that case, okay? So anybody has a one-off there, I know that's a little bit complicated, let me know. I'm going to share my screen, and let me preface by saying I just got a brand new computer. I thought it was plug and play as of yesterday, and it really wasn't. So let's go. Which
You got to live in
screen
the
do I
cloud,
want?
Caeli. You got to get everything in the cloud.
Thank you, Larry. Larry's going to help me later today get everything. All right, I think I want to be here. I'm not going to be looking at you guys because I'm not going to try and figure that out. What you should see here is a example Schedule E.
Perfect. You're looking good,
Okay.
Jim.
All right. So for those of you that are not familiar with this form, this is a dated one, but it still looks the same. You got your schedules on all of the tax return pages. You'll see the name of the schedule here, A, B, C, D, whatever. And then the year will be here. Each page of Schedule E will only have 3 properties per page. So if you had 9 properties, you'd have 3 pages of Schedule E, right? The property addresses will be listed here, and they will correspond, A, B, and C. They will correspond with the columns A, B, and C down here. Now, what I'm going to do with this information is there is an Excel worksheet straight from Fannie Freddie that's pre-formulated that tells me exactly what data I'm going to pull from here and where to put it into this pre-formulated worksheet. It's going to do all the pluses and minuses and the dividing for me, et cetera. And it's going to spit out at the end what the gain or the loss for that property is. Depending on how many properties you have, we're going to sum up the total. And then if it's a negative number, it's going to go into your liability column. If it's a positive number, it's going to go into the income column when we're calculating for debt to income ratio. Now, a few of the things that I want you guys to be aware of that are add backs. Depreciation, first and foremost, right here, is always an add back. It's a paper loss. So it's not, so if you see down here, line 20, this is the total expenses. And it tells you, if you've actually read through a tax return, it tells you exactly, if you read line by line, what it is you're looking at. So if you look at rows 5 through 19, here are the expenses, rows 5 through 19, the total is going to be on row 20. So this $97,000 here includes $25,948 of depreciation. I'm taking that out. That's not going to be an expense. It's a paper loss. It's to our advantage. Okay, depreciation is good. The other thing I'm going to look for quickly is row 14, repairs. Okay. Now, sometimes, and it's not a make or break, sometimes CPAs, and remember, the CPA does not have any idea what the underwriting guidelines are. Okay, they're there to save you money in taxes, right? Most of them, 99% of them, are not going to have experience with what we're talking about today. If, by the way, if you prefer that we work directly with your CPA and then report back to you, that's a very common occurrence within Ridge. We're constantly working with our client CPAs directly. We come up with a plan and then we present it back. Right? Their job is to take you all the way up as high as possible in the deduction. My job is to allow that without it taking you over, depending on what your goals are for the year. Okay. So a lot of times I'll see what we call one-time extraordinary expenses. All right. A one-time extraordinary expense is something that can also be an add back that will be taken out of this total number down here. Now, examples of one-time extraordinary expenses are going to be you recarpeted the whole place. A new furnace, a new roof, what would not be classified as a one-time, landscaping, right? That's something that you're going to continue to do again and again and again, that kind of thing. You know, I see all kinds of things listed on other. I should have had the statements here for you to give you an example of what this is, but I don't. So maybe you've got, you claimed education, right, from a turnkey. You've got some education course that you used for real estate investing, and I'll see them claim it, which rightfully so, I would too. But for our purposes, it's not an add back, right? That would not be a one-time expense. In any case, I really want to see those one-time expenses listed here. Okay, keeping in mind that if it's legitimately a one-time expense based on what you've defined it as, what you've told me it was for, I will need some kind of paper trail. I'm not going to just, underwriting's not going to just take your word for it. We're going to need receipts or invoices, something of that effect that shows the amount that we're trying to remove from those expenses. So ideally you have it here. Sometimes we'll see it here, sometimes I'll even see it in cleaning and maintenance. I've even seen it in supplies. So it's not the end of the world, but ideally if I get to choose, and this is why I would have a look at that draft return, I'm going to have the CPA. It doesn't matter to you or the CPA or the IRS which cell you put it in. I'm going to have you put it here. Another common mistake that I see, because they just don't know or it's just not known, is right here, the fair rental days. So most of the systems or the software that's using defaults to 365 or 366 on leap year, whatever it is. And if they just default and they don't look at the documentation, what's going to happen is that the income against the expenses is going to divide by 12 months. But if you've only had it for 6 months, or you've only had it in service for 5 months or whatever it is, and this was not dedicated to the appropriate amount of service days that it was actually rented, your number is going to be less than it should have been or could have been. And then lastly, I find very commonly that they'll omit insurance or they'll omit interest, usually not interest, but insurance and taxes and even depreciation. I find pretty often they're not listed there, but they're paying insurance and they're paying taxes and they should be taking depreciation. And why that matters is that once we've calculated all of the numbers, the pluses and minuses, the income, the expenses, the add backs, everything else, we're going to get a net monthly number. And from that number, I'm going to be subtracting the total mortgage payment, principal, interest, taxes, insurance, and HOA if it's applicable. So if you pay HOA, you better get it on your Schedule E. Okay. So when I subtract that PITI, that total monthly payment, from what the monthly net is, okay, and that's going to give me my final gain or loss. If you had not accounted for annual insurance, or you had not accounted for the taxes that you paid on this property, I am subtracting from that net 1/12 of that amount. So it will work to your disadvantage, greatly work to your disadvantage. So these are the kinds of things, you guys, that I'm going to be looking for when I see that draft return. And I do this all day long. My eyes are trained to go toward the places that I think are going to be impactful. Now, if you're an individual that might just be starting out and you have 1 or 2 properties and your debt to income ratio as it is super, super low, chances are, it's more of the exercise to teach you what the pluses and minuses are that you're looking at in these schedules if you're interested in that kind of stuff. But chances are you probably could absorb some big losses and it won't really matter too much, right? You can take all the excess that you want and DTI might be affected by 5 percentage points or whatever. But knowing at least basically what goes into the math of this, I think that is to any real estate investor's advantage. Why don't I take a pause and see what questions we have? Do we have any, Lair?
We do. We have one question from Stephanie Polito. Stephanie asks, would a roof replacement be added to the quote repairs line item?
Yes, that's where I would put it, Stephanie, absolutely. And that is an absolute one-time expense that would be taken out of the total expenses and not hit you or not be in the ultimate loss, the final loss number, if there was a loss.
I do want to ask a question. This is something that I've seen Ridge Lending come across in files that are being processed sometimes, Caeli, around this idea where the accountant or the tax preparer didn't actually know to ask the questions of our borrowers. So sometimes there is real proof of real expenses that were missed on prior year tax returns. And I know you said at the top that filing an amendment could be problematic for a loan, but can you speak to that in case somebody's listening and they're like, oh crap, I could have done that?
Yeah, absolutely. So I mean, if it's real legitimate and it's substantial, guys, by all means, right? And you have the paper trail and the proof, you can file the amended return. It'd probably delay things a little bit because on our end, we're going to need the tax transcripts of the new return to cross-reference what we have. But by all means, yes, if you know that there was some large expense that you should have taken that you didn't, and it's a difference between your qualifying now and not, because remember, if it was from several years ago, it's not going to have anything to do with us because we're going to take the most recent year filed. Okay, but if you lost out on some deduction, right, or you maybe do a refund as a result, by all means, go for it. I would. Is that what you were asking, Larry?
That's exactly right. Because sometimes we come across and like we've met with Ashish before, who's investor CPA, and we've done these things, and sometimes there's things that come across our desks and we're like, ooh, there's an opportunity for our clients
that may have been missed. Yeah, because that's the reality, guys, right? The CPA, they're not created equal. And even the ones that really understand real estate and can maximize your deduction, they're going to be missing underwriting guideline experience and information, knowledge. So it's important to have a communion between, I think, Ridge Lending and your CPA if you work with a CPA.
We do not have any other questions, Shelley.
Anybody else, guys? Going begging. I know that this is kind of heady stuff. Certainly one-on-one is something that we do on a regular daily basis with our clients so that we can advise them and prepare them. As far as I'm concerned, I think it's one of the greatest value adds for us as a company is really being able to let you guys take a look under the hood. This is not stuff that you can find on the internet. This is not something that you're going to get your loan officer from B of A to tell you. I'm not patting myself on the back, but I am saying that this is our space, right? This is what we do. So if you're interested in this at all and maximizing your buying power and your qualification, you should know it.
Did have one question from Michelle Caeli. So thanks
Michelle.
again. For those that want to ask questions, there's 2 ways to do it, 3 ways really. Raise your hand virtually or in reality. Ask a question through chat, or you can ask a question through the Q&A. There's lots of ways to get there. So Michelle Caeli chats, fair rental days, Caeli. Only count once the house is on the market available to rent. What's your feedback on fair rental days?
It should be the amount of time that income was received.
Gotcha. Very clean and straight.
Yeah.
And we've also seen, again, because I like to share things that we've seen where having the wrong amount of fair rental days on your tax return can really hurt you if it wasn't available.
Because that's what we're going to use. Once that tax return is filed, guys, that's what we're using, right? Remember, for those that may not have heard this, or just a refresher for those of you that have, there's 2 ways in underwriting that we're going to calculate income. Schedule E that we just looked at, that is only applicable for the property once that return is filed. If you've purchased a property before that tax return or that year has been filed, the acquisition year formula is very simple. It doesn't take all of the spreadsheets and the worksheets and that extra brain damage. It's 75% of the gross rents minus the PITIA, right? Up to 75% of the gross rents minus the PITIA, principal, interest, taxes, insurance, HOA, if it's applicable. That formula is so much easier, right? Anybody can figure that out. Take 75% of whatever your gross rents are, subtract out the mortgage payment, whatever the difference is, positive or negative, that's going to be your what's the underwriter's going to look at. Now, just quickly to quantify, for those of you that aren't familiar with this, it's up to 75%. The individual gets the full 75% is someone that has a primary housing expense, whether it's a mortgage or you rent, it doesn't matter. You have a primary housing expense, and you can show that you've owned real estate or rental properties for at least 12 months. If you have both of those distinctions, you get the full 75%. If you have only one of the 2, right, either one is fine, then you get to offset. You can't have any extra. If that formula, 75% of the gross rents minus the mortgage payment, if that produces a gain, a positive number, you don't get to have it. You only get to offset, which is fine, right? That's perfectly acceptable. Your DTI is unchanged as a result of that particular property. It would stay the same. If you have neither of those 2 things, you get 0 income from the subject property in the acquisition year. And remember, one more time, the acquisition year is applicable from the day that you purchased the property all the way up until that year's tax return is filed. So, quick example, if you purchased in January of 2022, and you know you're not going to file your return, if you're like me, until the 15th of October at midnight, then that acquisition year formula would be applicable to that property from that, what is that, 22 months, right? And by the way, looking at your draft tax returns, that might be part of our strategy, our philosophy, right? I think somebody, Lisa, maybe somebody asked a question earlier about that, in that if, maybe it was you, Nancy, but if you've got a property that you purchased in November or December, right? Once that thing lands on the Schedule E, because there's no income, but you got all these expenses, it's going to show a pretty big loss. So one of 2 things, I'm either going to tell you to take that property and carry it into the next year, or if you don't want to do that, I'm going to tell you to file an extension. I want until October of this year to use the more favorable formula, and it will always be, almost always be more favorable, that acquisition year, that simple formula, versus the Schedule E, at least for the first few years of ownership until the property tends to stabilize. And then, you know, it may be a different story, but I'm probably getting too far ahead of myself. Anything else? Anybody else?
Last chance. We just had one person jump in. Again, we do these every Tuesday, right? The whole point is to get engagement with the community. The recording, for those that were asking, the recording usually is up between 24 to 48 hours. If you're listening to this, make sure you go to the Ridge Lending Group community and type in live with Caeli, and you can see all the replays that we have on there. You can also check out replays on the podcast if you'd like to listen, or you can check out the replays on the YouTube channel also. One last from Kia. And again, I apologize if I've got that wrong. So the note is thanks. This is my first time on the call. Yes. I couldn't follow everything, but I'm sure I'm in the right place to learn. I don't have any properties yet, so I'm looking forward to working with you and getting guidance so that this can be successful. And if you have any questions after today, again, if you're here with us or listening, you can always call Ridge Lending Group, talk with any of the dedicated lending specialists, including getting on Caeli Ridge's personal schedule. Call 855-74-RIDGE, which is 747-4343. You can email to info@ridgelendinggroup.com. You can apply online. You can go to ridgelendinggroup.com and apply online. And lots of ways to get involved, right, Caeli?
Absolutely. We'll be here on standby, guys. Anything you need, this is what we do. So please take advantage of these resources. They're just not out there, easy access. That's why we're here, to support our investors. We love this community. So hit us up.
Jag, just as we're parting, Jag did ask a question about properties with single member held LLCs. Caeli, I think we should hold that for next week. Maybe we start with that one. We'll put that out for the community for a poll.
Okay, we'll get that poll out to you guys. You let us know what you want to hear, and we'll make sure that we bring the good content for you. And as always, we are on standby, phone call or email away.
Everybody, thanks very much for coming. Caeli, thank you as always. Everybody take care.
Thanks, guys. See you. Bye, everyone.